Let's talk about just where this market sits here as we get through October, and it seems as if we had people kind of tensed up, perhaps for some volatility, have not gotten it. If you go down your bull market checklist, what does it tell you right now?
Usually when the market does really well during a seasonally weak time of the year, we interpret that as being bullish, that the market can withstand those headwinds rather than saying, oh, the market's really overbought. For example, when the S&P has been up 20% through September, during the fourth quarter, it's up an average of another 4%. Now, fourth quarter usually a pretty good quarter, so it's not marginally better than all fourth quarters, but it tells you the rally tends to continue when you have a good start to the year.
And so we also are, I guess, paying some attention here to this maybe equilibrium that's moving around between where bond yields are, where expectations for what the Fed might do. You have earnings coming up as support, but and you have a relatively high valuation. So where does that all come together for you?
It's a really fine balancing line, and so far the market's been able to walk that line very well. For example, the Citigroup Economic Surprise Index, which had been really positive, meaning a lot of economic data had come in better than expected, was negative for a few months earlier this year, recently turned positive. That tends to be good for stocks. The caveat to that is when the economic data looks a little bit better, interest rates tend to rise. And we've already seen a decent move from the 10-year Treasury yield. We just don't want that to rise too quickly. So if we get, say, 430, 450 just in the next few weeks in the 10-year, I think that could change that balance where there's more concern about a no landing, the Fed not being able to cut rates as much as the Fed wants to. So right now, that's in pretty good shape. And I'd throw in on the earnings side of things, we're looking at quarter-on-quarter acceleration in earnings growth again in Q3, which is positive. The difference between Q3 and what we saw in Q2 and Q1 is that the expectations are much higher. Consensus estimates are jumping from mid-single digits year over year to more like mid-teens year over year. So it's a little bit of a higher hurdle for the market to climb. So you have to balance all these things out. But overall, it's a pretty positive environment.
And Ed, I know you've been making the case from way back that if the Fed is actually moving more slowly as it lowers interest rates, doing it in a deliberate way, that tends to be better for stocks. Obviously, it means they're not rushing to save an economy that's faltering. That seems to be what we're headed for right now. It actually brings me around to this idea of, you know, in this pileup of positives, what would you look for to suggest that maybe, you know, people are over-believing it or investors are getting a little bit too overexcited about admittedly good fundamentals?
Yeah, you're right, Michael. When the Fed has cut 4 or fewer times in a year, on average, the S&P is up about 25% in that first year. Not a prediction, just tells you historically what's happened versus only 5% when the Fed has cut very quickly. So in terms of what could go wrong, I think we want to go back to that earnings discussion. If analysts, who usually are pretty optimistic, if those estimates prove to be wildly optimistic, that would be a big concern. And so if that happens, or if interest rates will rise too quickly, we'd be pretty concerned that the Fed wouldn't be able to cut at all. And that's a pretty dangerous environment where the Fed only cuts once or twice and has to reverse course because they lose credibility. Inflation rears its head again, and then we have to deal with, to some extent, what we were dealing with a few years ago with higher than expected inflation.
All right.